Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, rate strategist, and I'm joined today by only one global market specialist, Giles Gale. So Giles, you've got the lucky job this week of talking to the US and Europe. Let's start with the US because, I think we've probably had the most news out of the US this week, and certainly it feels like it's been the US that's been driving global rates markets. So we're recording this on Thursday. We just had the minutes from the last month's FOMC meeting overnight for us here in the UK. What did we learn from those minutes?
Well, okay, I mean, it's been a volatile ride overall, to be honest with you. I'm just looking at the chart now, I have it in front of me. I mean, 25 basis points sell-off in 10-year treasuries in, well, a week. And I mean, there's been a lot of chopping around within that over a few weeks. So, I mean, this is moving a lot. You know, I mean, maybe I'll just back up very slightly and mention that there were some important Fed speakers as well who were, one in particular, Lael Brainerd, who is renowned for having a track record as a particularly sort of outspoken and influential dove who had some rather more hawkish things to say, and really focusing on the quantitative tightening side of things. But the clear message, I think, from the FOMC overall, and that did come through in the minutes as well, is that the Fed is increasingly concerned about inflation. It increasingly wants to get rates higher and withdrawing accommodation faster than even recently. And so, completely understandably, markets have been reacting to that, pushing higher in terms of what they're expecting from the Fed, both at the front end, and that's kind of propagated out the curve. But of course, we've had quite a lot of discussion about what's going on in things like curve inversion. Does that mean a recession, and so on and so on and so on. So maybe those are things that we can come back to in future weeks.
Thinking further out the curve, then obviously, we had learned from the minutes about faster and bigger, perhaps, rate hikes than we've been originally expecting. But what about quantitative tightening? We're expecting a May announcement on active sales from the Fed. How did the minutes shed any light on or change that view, if at all?
Well, I think that there are two things. I mean, I think markets were uncertain whether quantitative tightening might begin in May or whether it would be announced in May, maybe start in June. It seems like it's increasingly likely that the start will be in May now. And then there was some discussion in the minutes about the size of the runoff. And just to remind people the way that this works, the Fed holds a lot of short-term paper and will continue to hold a lot of short-term paper for years to come. If they just allow that to redeem, then the balance sheet will actually shrink reasonably quickly. And so what they do is they say, okay, fine, we'll take it as it comes, but we won't let it shrink any faster than certain caps that we set. And so effectively, because of the profile of what they hold, within reason, the caps will pretty much determine the pace of balance sheet runoff. And so what the minutes seemed to suggest was that the pace is gravitating towards a 60 billion cap for treasuries and a 35 billion cap for mortgages. So total about 95 billion. Now that's pretty, I guess that overall is an acceleration compared to maybe what people had in mind. We've had long discussions about the degree to which quantitative tightening necessarily matters at all, because of course all the action is at the front end where there isn't any meaningful duration impact. And I don't think this is the time to get into that right now, but it is interesting that quantitative tightening seems to have been put on the global agenda by by Brainerd. And we've, of course, from the Euro side, been saying that it's actually the main thing, much more than rate hikes this year. And it seems like we've had finally the market sort of come round to our way of seeing things a little bit, but again, provoked by the US on this occasion. So just to finish off these thoughts, we had a disinversion of the US curve as a result of that, because
Disinversion, is that a technical term?
it's a perfectly valid term. I don't think I've invented it. Maybe I have, but anyway. So there was a disinversion because obviously I guess the market sort of figured, well, the emphasis is maybe a little bit more on quantitative easing side or quantitative tightening side, and maybe there's a quid pro quo at the front end, but maybe also, and this is another thing that I'll just leave as an open question. I mean, for a year now, I think that the concern has been about consensus steepeners and the degree to which those have been squeezing the curves globally flatter, and maybe this is a sign that the consensus is now in flatness.
I guess just before we move on, because you kind of segued nicely into other regions there with regard to quantitative tightening becoming the theme, but just before we do move on to those, to wrap up the Fed discussion, because since we last spoke on Bondcast, our US economics colleagues have updated their Fed call in terms of what they're expecting for rate hikes this year. So could you just update listeners on that, because if we start talking about that, they might be a bit surprised.
Yes, okay, right. Get your pencils out and take note. So we now think that we're going to have 3 successive 50 basis point rate rises from the Fed. And then after that, for the remaining 3 meetings of the year, another 3 successive 25 basis point rate hikes. And so that would land us in the range for the Fed funds target. I think it's 2.5 to 275. For the end of the year, which is a little bit above the dots. And the last I looked, although I'd have to check given the volatility, it was a little bit above where the market was as well. But it's there or thereabout. And then we expect the funds target range to continue to rise in the early part of next year to end up at 3 to 3.25. Okay, right. So Imogen, it's your turn now, because you billed me as the only market specialist on the podcast today. But of course I'm not. You'll be far too modest. So listen, it's probably a good time, given all the chat about QT, to talk about what this, what the situation is in the UK. We're almost approaching that 1% threshold in bank rate, where they said that they would consider active sales, with the Fed expected to announce soon. The focus will inevitably shift to a greater extent towards the Bank of England's QT. And so what are you thinking about that?
Yeah, I think you're right. The fact that this 1% threshold that the Bank of England announced is obviously approaching, we think, and strong consensus is that it comes at the next meeting. And like you say, this Fed has kind of triggered a global conversation about quantitative tightening, means that this is going to return to the forefront of the discussion in the UK. I think there's a few things that are important to note. The first of all is that the Bank of England wording is that the process will begin at 1%. My view is that's probably deliberately ambiguous, because what does the process really mean? Does that mean they start doing the background work when we get to 1%, or do they start active sales? There's nothing so far to suggest that any of this kind of background work or working groups in terms of what this impact might be has already taken place. So it doesn't seem like they're in any rush. I certainly think that's going to be addressed in the May meeting, because obviously that's when we think they do get to that 1%. But so far it doesn't seem like they're either in any rush to do so, or are particularly viewing this as a monetary policy lever or a monetary policy tool. They've been very clear that any active sales will be gradual, and they'll be, with a subject to market conditions, and with a view of not trying to, control the yield curve in particular. So with all that in mind, I think it's probably, given that we don't have much information to go on, our kind of broad base case at the moment is that a gradual rundown of the stock probably looks like something like that they would want to unwind pretty much all of their pandemic purchases, which is almost equivalent to halving their kind of stock of gilt purchases over the next 5 years, let's say, which when you add in the kind of active runoff of, the natural runoff of the portfolio implies active sales in our base case of around 50 billion a year beginning in 2023, we think.
Okay, and so bottom line then, what does it mean for gilt yields? And I have in mind an eye-popping chart that you showed me this morning.
Yes, well, not sure what's going to come out first, the podcast or my note, which I'm still writing. But one or the other the note will have this chart, and hopefully listeners, if they have access to our notes, will be able to access that. But I think that the conclusion is really that, as we've talked about with reference to the Europe and also the UK on this podcast so many times before, is just that, supply net of Bank of England purchases is going to shift significantly higher over the next couple of years, and that shift from 2022 versus 2021 is big, but that's only going to get bigger over the coming years. If you look at gross gilt supply net of APF purchases, the average of that between 2012 and 2021 is somewhere around 100 billion, and if you look at it between our expectations of how the runoff might look like, plus the CGNCR numbers taken as our kind of forward-looking gilt supply numbers, that number doubles to over 200. So it's a really big shift, which obviously implies bearish pressures to gilts, we think, particularly at the long end of the curve. Although that has to be taken in context of everything else that's going on in terms of bank rate expectations and global conditions, blah, blah, blah. But essentially, when it comes to our gilt model, we estimate that every 10 billion of gilt stock rundown of the APF is worth around 3 basis points on 10-year gilt yields. So that 50 billion, announcement of a potential 50 billion of sales next year could be worth, we think, about 15 basis points of upward pressure in 10-year gilts.
Yeah, I mean, I was particularly taken by that chart that just shows how many gilts we're going to get over the next 4 or 5 years. I mean, it really is. I mean, I wonder to what extent people really realize how much of a change we could be on the verge of here.
Yeah, it really doesn't. I mean, we've had this discussion so many times on the European side as well, but it really doesn't feel like either of the European markets, Europe or UK, are pricing in, how much more supply we're going to get with central banks stepping away fully. So speaking of which, then let's move on to the ECB. We have the meeting next week, of course, but before then, we've had the minutes from the last meeting this week, or just now, actually, as we're recording this, hot off the press. Now, a reminder for our listeners that these were the minutes from the meeting where they surprised on the hawkish side by recalibrating the tapering of purchases to a much faster pace than we were expecting. But since big hitters, I would say, on the ECB Governing Council have come out and been slightly more dovish than the tone of that meeting might have suggested. So did we really learn anything new from these minutes, or do you think it was kind of old news given how the tone has shifted between some council members since then?
Yeah, I mean, it's interesting, isn't it? I mean, and I'm going to say straight away that it's a long document and I haven't had time to fully digest it yet. But I mean, it seems like, I mean, well, you can certainly see the way that there was, kind of push and pull between those, on either side of the debate that we know well. It seems like overall, there was a bit of a hawkish lean. Clearly there were people who were pressing for an end date to APP, and there's quantitative easing in the summer, some discussion of the contingent who would like to see a Q3 rate hike, which is earlier than we have penciled in, but nonetheless obviously can't be ruled out, and I hasten to add is far from being ruled out by the market. In fact, the market has that nailed on as strong base case now. So no, let's see. I mean, maybe it's better to just get on to our expectations for the ECB next week. It's slightly unusual, to be honest with you, to have to only have 1 week between those minutes and the meeting itself, of course.
Yeah, it felt really soon to me. I must admit, I only really realized at the beginning of this week that was the calendar. But you are right. Let's not be backward looking. Let's think about the future. So what are our expectations for next week then? Like I said, we had a big kind of policy recalibration at the last meeting. Does this feel like it's going to be more of a placeholder meeting, given that uncertainty is still high? They've just adjusted policy, or do you think actually, given the kind of global developments, that we're going to hear more from them? I guess particularly around the path of rate hikes in the future.
Yeah, I mean, having half suggested there that I might actually have something dramatic and interesting to say about the next week's ECB. I actually don't particularly. I mean, the outlook is equally clouded by exactly the same clouds as it was last time around, and so we know obviously we know what's at stake here. I mean, growth is clearly showing now signs, completely expected signs. I know I should stress, but I mean the expected signs of slowing growth that are now showing up, and we obviously have the same concerns about inflation that we had when was it 4 weeks ago, and so into that I don't really see why there would be any need for the ECB to change anything. So essentially what we're looking for them to do is to repeat the main points from the last meeting. But in particular, I think they will, I mean, clearly we're expecting to confirm that their timetable for ending QE over the next 2 and nearly 3 months is still in place. I think that they'll be invited to talk about the timeline for rate rises, but won't necessarily be drawn out particularly on that. They'll just fall back on their language of sometime after we finish QE, and that's it. No, we're not looking for any big new innovations around policy. Just the usual expression of concern about the possibility that if there's any kind of sign of financial fragmentation, then they will fall back first on flexibilities, and then they have the ability to innovate within their toolbox and so on and so on. So no, I don't see this as a big one. Bottom line.
Yeah, fair enough. They can't all be big ones, can they? Okay, so moving away just lastly from central banks, because it feels like all we've discussed on this podcast recently has been central banks and inflation and growth, but actually we've got a bit of political risk being reintroduced in Europe this week. Markets have finally focused on French elections. I think other concerns have been higher up the list of late, but given the proximity and also the fact that perhaps the polls are or Macron's lead in the polls has been narrowing, or a little bit volatile, but narrowing of late. Markets feel like, or markets' attention has certainly returned to French political risk. So how do you view those risks, and what does that really mean for markets?
Well, okay, so we highlighted these risks. I would like to emphasize last Friday, as in, well, I guess by the time anyone listens to this, a week ago, and that was just before markets started to notice that actually maybe they were a little bit complacent about the risk that we may wake up in 2.5 weeks with a Le Pen presidency in France, which, I mean, not to get too much into politics, I think it's safe to say that that's not an outcome that markets would, in general, welcome too warmly, just because I mean, it's the less known entity. I mean, she has policies, for example, surrounding the NATO that would concern some. Again, taking a market's view here, and also, I think that it would potentially raise questions about the ability of France to really forge ahead with sort of improvements and deepening of the European Union with partners like Italy and Germany. So, which are all things that markets tend to look forward to, hopefully, let's say. So we've had a correction here in French spreads, especially, and to be honest with you, I think it's probably enough at the moment. Just looking at the last sort of 10-20 polls, there doesn't actually seem to be any significant further momentum in Marine Le Pen's in favor for that second round. There were a couple of polls which got people concerned, but overall, I don't really see that developing. That's not to say that in the next couple of weeks it can't, of course, and that's not to say that we won't be looking very carefully at the first round results for evidence of apathy on the left that might result in abstention, unhelpful abstention for Macron. The degree to which the right is energized and mobilized and so on. All of those things will be looked at very, very carefully. But there's still all to play for. I mean, there'll be debates, there'll be the potential for missteps. What happens in Russia is important in various ways that I won't get into at the moment. But and there are ongoing difficulties with. I mean, just to take one example, Macron's use of consultancies, which has not played well with the French electorate, and maybe that goes away. Maybe it intensifies as weaknesses are identified. And so, I think the bottom line is that it's going to be a difficult couple of weeks potentially. With some volatility, but overall, I think that the risks are priced for the information that we have now. Now, I just say that this mixes with the overall sense that as quantitative easing is slowed, there is this question about how primary supply is taken down, and so that then sort of becomes a separate question for France, but potentially at a bit of a sensitive moment, let's say. So let's just keep watching this, and maybe in 2 weeks' time we can take stock.
Sounds good. And just a reminder for any of our listeners that if you do have access to our kind of strategy notes on Agile, you can pick up the note that Giles mentioned around the French elections. We've also put a French election preview on our On Point website, so that's NatWest's insight website for anyone who doesn't access our usual strategy notes via Agile. All right, with that then, let's finish there. Lots to talk about, but a couple of busy weeks ahead as well. Lots to look forward to. So I look forward to catching up next week. Thanks, Giles, for joining me. And just a reminder to our listeners, if they like today's episode, don't forget to hit subscribe and the like button to show your appreciation. And we'll chat again next week. Thanks. See you soon.